CEO, Bank of Baroda, executive directors and other senior executives and all other officers from Bank of Baroda, distinguished bankers, many senior bankers who are present here, past and present, ladies and gentlemen, members from the media. I'm extremely delighted to be here among such a distinguished gathering at the Bank of Baroda Banking Conference. I wish to compliment Mr. Chadha and his colleagues for organizing this event in the physical mode and having chosen a theme which is so relevant today, that is banking beyond tomorrow. So we are not just looking at tomorrow, but we are looking at beyond tomorrow. It's a futuristic plan and banks need to move in tune with the requirements of changing times that we are living in. Given that the banking landscape is witnessing far-reaching changes in the backdrop of rapid innovation, disruption, and evolution of new business models, I believe the theme of today's conference merits very active discussion, and I once again compliment Bank of Baroda for having selected this topic for as the theme of this conference. In my address today, I propose to touch upon the current macroeconomic situation, followed by highlighting the special role played by the banks and the new trends emerging in the banking sector. I shall also attempt to highlight what banking beyond tomorrow may look like and the opportunities and the challenges that it may bring along. Let me first talk about the macroeconomic situation. I would like to focus specifically on where we stand today. We are living in very turbulent times. The continuing war in Europe and the COVID-19 pandemic have rendered the global macroeconomic outlook highly uncertain. Countries are facing unexpectedly high inflation, including food inflation, supply chain disruptions, and demand-supply imbalances in both product and labor markets. Central banks are tightening monetary policy at a very rapid pace, raising fears of imminent recession. Commodity prices have eased somewhat in June, but they remain elevated. Higher interest rates in the United States, along with increased risk aversion among global investors, have fueled safe haven demand and strengthening of the US dollar. Currencies of emerging market economies and even currencies of some advanced economies are depreciating vis-a-vis the US dollar. Consequently, inflationary pressures are building up and external funding conditions are becoming tighter, posing financial stability challenges in emerging markets in particular. Overall, the global situation remains grim amidst fluid geopolitical situation, while the war and the pandemic add to the forces of disintegration and fragmentation of the global economy. In such an environment, the Indian economy remains relatively better placed, drawing strength from its macroeconomic fundamentals. The financial system is well capitalized, asset quality indicators have improved, balance sheets are stronger, and banks have returned to profitability. We are also seeing healthy pickup in credit demand. The external sector is well buffered to withstand the ongoing terms of trade shocks and the portfolio outflows. The recently released Financial Stability Report of the Reserve Bank highlights that the Indian financial system remains resilient and supportive of the ongoing economic revival. It also shows that banks are well positioned to withstand even severe stress scenarios without falling below the minimum capital requirement. The Reserve Bank continues to remain watchful of the headwinds and shall be proactive in taking measures as may be necessary from time to time to ensure financial stability. Recent developments in the forex market have generated intense debate, including predictions of rupee dropping to record lows as foreign portfolio funds exit India. I would like to address the issue in a balanced and factual manner, and I have attempted to be as objective as possible. First, it is important to recognize that spillovers from the global monetary policy tightening, the geopolitical situation, the still elevated commodity prices, especially prices of crude, and the lingering effects of the pandemic all coming together have become overwhelming for countries world over. Even reserve currencies such as the Japanese yen, the euro, and the British pound sterling have not been spared. Portfolio funds are selling off assets and fleeing to safe haven. Emerging market economies are particularly affected by capital outflows, currency depreciations, and reserve drawdowns, complicating macroeconomic management in these countries. Second, the impact of these overwhelming spillovers on India has been relatively modest. In fact, the Indian rupee is holding up well relative to both advanced and EME peers. This is because our underlying fundamentals are strong, resilient, and intact. The recovery is gradually strengthening. The current account deficit is modest. Inflation is stabilizing. The financial sector is well capitalized and sound. The external debt to GDP ratio is declining. The foreign exchange reserves are adequate. Third, in recognition of the fact that there is a genuine shortfall of supply of forex in the market relative to the demand because of import and debt servicing requirements and portfolio outflows, the Reserve Bank has been supplying US dollars to the market to ensure that there is adequate forex liquidity. After all, this is the very purpose for which we had accumulated reserves when capital flows were strong. And may I add that you buy an umbrella to use it when it rains. Fourth, a predominant part of the outstanding ECBs is effectively hedged. Let me elaborate. According to the June 2022, the last month's financial stability report of the Reserve Bank, the outstanding ECBs of the outstanding ECBs of 180 billion US dollars, 44% or 79 billion US dollars is unhedged. Now this includes about 40 billion dollars liabilities of public sector companies, mainly in the petroleum, railways and power sectors, which have assets with a natural hedge character. Besides, being public sector entities, their foreign exchange risk, if any, can be absorbed by the government if so required, but that possibility is highly unlikely. The remaining US $39 billion ECB represents 22% of total ECB's outstanding. Even this includes borrowings of those companies which have a natural hedge, that is earnings in foreign currencies. This would leave a small portion of the total outstanding ECB that are truly unhedged. So it is necessary to look, the so-called unhedged forex reserves in its proper context, rather than get carried away or get alarmed by what is revealed on the surface. We need to look at it deeper, we need to dissect it and look it in a manner that is objective and fair and true to facts. So that's why I am saying that the truly unhedged portion of our so-called unhedged ECB outstandings are far too lower than the $79 billion, about which I think there has been some conversation in the recent days and weeks. Now, corporate entities eventually face a trade-off. If they hedge their foreign exposure completely, the cost of borrowing goes up and the advantage of cheaper borrowing in foreign currencies is lost. On the other hand, to the extent they do not hedge, debt servicing can go up when the exchange rate is under pressure. This has led to the concept of optimal hedge ratio, which calculates the proportion of hedging that minimizes the variance of portfolio. For India, our internal research, that is the internal research of the Reserve Bank research team, estimates the optimal hedging ratio at 63%. In fact, this was one of the bulletin research articles which was published sometime perhaps last year. Now, taking into account natural hedges and the exposure of public sector companies, the optimal hedge ratio condition of India at the moment is comfortably satisfied in the case of the stock of ECBs, in which, ECBs in India's external debt. Due to the RBI's actions, including measures to encourage inflows, the movements of the rupee have been relatively smooth and orderly. By eschewing sudden and volatile shifts, we have ensured that expectations remain anchored and forex market functions in a stable and liquid manner. We will continue to engage with the forex market and ensure that the rupee finds its level in line with its fundamentals. I would like to reiterate that we have no particular level of the rupee in mind, but we would like to ensure its orderly evolution, and we have zero tolerance for volatile and bumpy movements. I would now like to focus and turn towards banking. Banks are special and not like any other commercial entity. They are not just custodians of shareholders' interest, but more fundamentally the trust of the depositors. Depositors are at the very core of the entire banking system. Protection of depositors' interest is paramount to a robust, reliable, and stable financial system in the country. It is important for banks to always remember that the funds they deploy belong to the depositors, and this should reflect in proper risk management, governance, and internal control systems. Some of these points were touched upon very briefly by Mr. Sanjeev Chadha in his welcome remarks. Banks are also expected to be permanent institutions after they obtain a license from the regulator. They are governed by sound regulatory and supervisory practices. The bigger responsibility, however, lies with the banks themselves to ensure robust governance and risk management, which are integral to the functioning of a bank. Going beyond regulatory prescriptions in terms of capital, liquidity, and provisioning norms, and even exceeding them, would be a sign of good governance and robust risk management. This will future-proof the banks and enable them to fall back on their own balance sheet during situations of stress. It needs to be emphasized that while shareholders' interest is important in the business of banking, even more important is the interest of depositors. Shareholders of banks should focus on long-term profitability and long-term market valuation. This should lead investors to look at a banking entity for the value it would generate over the medium to long term. This approach will usher in a new paradigm of banking and will stand in good state for our economy. I would now like to focus on, the main theme that is preparing the banks for tomorrow, that is banking beyond tomorrow. The banking sector is going through a period of churning. The future of banking would witness a major shift in customers' choices and preferences with enhanced expectations from the banking industry. Each of the developments would present unique opportunities and challenges to the existing and newer players. It has to be borne in mind that sometimes the disruptions can be so sudden that it is impossible to anticipate them. To me, however, it seems reasonable that banking beyond tomorrow would revolve around, number one, the adoption of emerging technologies, customization of products and services, enhanced business and process automation, and number two, development of suitable business models with strong governance frameworks, better information management, changes in the mode of working, building of enhanced resilience capabilities, and more responsible societal and environmental role for the banks. Let me dwell upon the above in some more detail. The Indian banking system has undergone significant changes. The increased adoption of technology by traditional banks through self-upgradation or collaboration with fintechs is resonating with the idea of new age banking. This is leading to innovative products and services and newer business models. In this context, it is often cited that banks will face competition from fintechs, which are already making their presence felt within the financial services space. Today's customers, especially the retail customers, expect banks to provide them quick, reliable, and personalized services. Therefore, to stay relevant, banks would need to embrace newer and tested technologies for effective and timely business decision making, understanding the needs of their customers, and delivering personalized services to them. Banking beyond tomorrow would necessitate significant investment in technology and organizational capability. Globally, banking is becoming more open, facilitated by availability of newer technologies and application programming interfaces, that is APIs, that allow interoperability among banks as also fintechs. This development presents unique opportunities for collaboration among various participants for faster and improved delivery of products and services suited to the customers. Unlike other developed countries, India has embraced a hybrid model where both the regulator and the market have collaborated for the development of open banking. UPI marked a watershed in the commencement of open banking in India. The success of UPI, implementation of the account aggregator framework, and the mass adoption of digital banking services, with all these, India is witnessing an emergence of new business models. More and more banks are opening up for collaboration with new age service providers for facilitating customers to make better use of their data and avail a wider and richer set of services. Now, given the digitization wave in banking world over, and with the new tech-savvy customers that we have and whose numbers are growing from day to day, banks must also strike a fine balance between digital and paper-based forms of communication. While the apps and websites of banks have grown in leaps and bounds over the years, there is still substantial scope for facilitating easy navigation for customers. Simplifying disclosures and access to information, and innovative deployment of tools such as chatbots to help customers navigate through the websites and mobile applications will greatly enhance the banking experience. Financial inclusion has been pursued vigorously with steady improvements as reflected in the Financial Inclusion Index introduced by the Reserve Bank of India. In fact, we released the latest Financial Inclusion Index, and it shows substantial improvement over what we had in 2019. And 2019 itself was a substantial improvement over the previous period. Receiving digital payments such as wage payments, government cash transfers, and domestic remittances are catalyzing the financial inclusion drive. With digital technologies, while digital technologies are also offering a powerful way to overcome barriers to access banking and financial services, we also need to be sensitive to the requirements of our people to avoid any kind of digital divide. The presence of human touch in traditional branch banking would still be relevant for customers in many respects and in many areas. There is also a need for providing timely and seamless credit to agriculture and MSME sectors as a part of the focus on financial inclusion. Social media is an alternative platform for reaching millions of customers. Indians on an average spend around 2.4 hours daily on social media. Further, the number of social media users has been growing very steadily. The analysis of social media use has the potential to help banks in reviewing their strategies in terms of customer segmentation, customer acquisition, and furthering financial inclusion. Social media can also be used in customer grievance redress management. With advancement in digital banking, cybersecurity will remain an important challenge for all stakeholders. The increasing use of IT systems by banks, remote working arrangements, accelerated adoption of digital banking services by customers, along with increased dependence on third parties for various services, would warrant enhanced resilience capabilities to ensure business continuity. This would include building strong defenses against cyber attacks and malicious attempts at disrupting, disabling, or destroying a computing infrastructure, or stealing confidential information and data. Banks would need to undertake constant upskilling of personnel in this regard. Continuous knowledge acquisition and staying ahead of the curve would become even more crucial in the days to come. Climate-related risks will be the focus area in times to come. Such risks will impact the business models of banks. The increased requirements of funding businesses and industry for tackling climate change would be greatly influenced by the global move on climate-related risk management. Various stakeholders already consider environmental, social, and governance, that is ESG, as an important aspect while making investment decisions. Banks are also increasingly aligning their businesses, including assessment of financing assets, with the global climate sustainability agenda. The need for banks would be to develop appropriate business strategies and strengthen the governance framework to gauge the associated risks. In line with international best practices, a forward-looking, comprehensive, and strategic approach would be required to address the climate-related risks. Let me now try and conclude. Going ahead, the world of banking is expected to be more collaborative as well as competitive, with newer players offering innovative financial products. Banks need to prepare themselves for facing the dynamic environment while keeping their focus on appropriate business models, sustainability, stability, and customer centrality. More importantly, good governance remains fundamental to success and should not be compromised at any time. Due care needs to be taken to protect the stakeholders from digital frauds, data breaches, and cyber crimes. At the end of the day, banking is a service, and enhanced customer protection and experience should be given primacy it deserves. From the regulator's perspective, the Reserve Bank is fully committed to build an enabling environment for accommodating the new disruptive innovations in a sustainable manner while preserving financial stability. History suggests that when technology, market participants, and regulators join hands, revolutionary innovations and growth would follow. I hope our banks of tomorrow will make it come true, and that is precisely the essence of, that is precisely what would constitute the essence of banking beyond tomorrow. Thank you very much.
Thanks a lot, Governor, for your address. I think it covers all the subjects which we're going to discuss during the course of the day. And I think you've set the tone for it. You've actually brought up all the issues that need to be discussed. And that's going to be very enriching for all of us. We're now going to have a fireside chat with Governor, and our MD, Mr. Sanjeev Chadha, will be conducting it. So it's over to you.
Thank you very much, Governor, once again for that tour de force. We are really reassured about the fact that in terms of the external sector, despite what's happening in the neighboring countries, India is in a different and a very strong place. Also, I think the areas you covered in terms of what banks need to focus on, I'm sure that will define the agenda for not only this conference, but also for next few years. A few questions, Governor, first on the monetary environment, and then a few other areas that you also touched upon. So first, again, it seems to be the case that we may be moving now from an era of great moderation to a time of great uncertainty, or even perhaps great volatility. Volatility in terms of commodity prices, supply chains, supply shocks, inflation, and interest rates. Inflation targeting has worked very well in the time of great moderation. However, the question is it an appropriate framework during great volatility, or central banks need to have the advantage of a little more flexible framework?
I think the current framework that we have with regard to inflation targeting has worked very well over the years. We positioned this inflation targeting framework in our country in 2016, and the average inflation, CPI inflation, till the onset of the COVID-19 pandemic in February of 2020, till that period, from 2016 to the onset of the pandemic, the average CPI, the headline inflation, if I remember correctly, was 3.9%. Now thereafter, we had the huge shock coming from COVID, and because we have flexibility inbuilt into the target, 4% plus minus 2, so the MPC, as you are aware, decided to use that flexibility, to use that space to tolerate a slightly higher inflation that is higher than 4%. And that it is that flexibility which is built into the inflation targeting framework that allowed the MPC to, allowed the MPC and the Reserve Bank of India to reduce policy rates, to inject huge amount of liquidity, and several other measures which were taken by the Reserve Bank to fight the onslaught or the impact that the COVID was producing, not only on the financial sector, but also on the real economy. So the entire framework has worked quite well, and inflation targeting is something which is important at all times. And ultimately, as it is said and as it is well known, the common person, he suffers the most if there is high inflation. And inflation and, without any price stability framework may lead to other kind of consequences which will undermine the, the financial stability of the country. Going forward, unless the central bank is mandated to control inflation and maintain price stability, unless the central bank, as a follow-up to this mandate, takes steps to adjust the policy rate accordingly from time to time, the negative interest rates will increase. It will act as a big disincentive to savers. It will be a big disincentive for financial savings, and less of financial savings will obviously have an impact on the investment outlook or the entire investment climate of any country. Now, there are other consequences also. So I feel that because we have gone through this kind of crisis, the COVID, and now the the war in Europe, which has again produced a lot of consequences in the real sector, in the real market, in the real economy. I think having an inflation target and trying to achieve that ensures that the aspect of financial stability, not only in India but world over, is maintained. And that is the key to maintaining financial stability. And so far as India is concerned, the framework has worked well before the pandemic, during the pandemic, and even now. I would say that we are very much in line with the requirements of time in terms of the steps that need to be taken. So therefore, I feel that it is the framework has worked well and needs to continue. And my personal opinion, and also I think this is the opinion of all of us in the Reserve Bank, is that let's not shift the goalpost to just suit our convenience, because the larger requirement of the economy and the financial sector is to have such a framework.
Thank you, Governor. Just a connected question. While almost all central banks have moved to tighten policy, almost in a coordinated manner, they are in very different situations. For the ECB, it seems to be all bad choices: either control inflation or confront a potential sovereign debt crisis, while the Fed seems to be better placed, with the underlying dynamism of the US economy likely to remain intact even if it were to engineer a recession. How would you rate India in this context? Could rate hikes threaten an incipient recovery, or is growth momentum likely to continue to gather pace, despite what is the normalization of interest rates possibly?
You see, as the MPC has, as the MPC statement, the minutes of the MPC resolution, as it has been clearly stating, and as I have also mentioned it earlier and in my statements, our decisions on rate hikes or decisions relating to liquidity, they always take into consideration the aspect of growth. Now, the mandate says, that is the law says, the mandate says that RBI is responsible to maintain price stability, keeping in mind the objective of growth. So the objective of growth has to be kept in mind at all times. We have now changed the sequence, meaning in sequence of priorities, currently our focus is on inflation followed by growth. So any decision that we take with regard to liquidity, with regard to the policy rates, always takes into consideration the kind of impact it is going to produce on the growth and the revival of economic activity. The what you call the high frequency indicators in the first 3 months of this year and even in July, so far as India is concerned, they're looking very positive. And in fact, whether you look at GST collections or you look at e-way bills, there was a slight dip in between, but they have improved. The aggregate demand has also improved. Urban demand is fairly strong. The rural demand is showing now signs of picking up. The demand for, Mahatma Gandhi Narega, the demand for work under Mahatma Gandhi Narega has also moderated. So there are several signs of high frequency indicators, or for that matter, the sale of passenger vehicles, the sale of tractors. I think all of this is showing, they are showing positive development. So our approach is to deal with the problem of inflation squarely, but keeping in mind the objective of growth. And ultimately, we cannot, as I have said earlier, that our target is and will continue to ensure that we have a soft landing for our economy. We had reached a kind of soft landing till the war broke out, the war in Europe. Then the war has created new challenges. And now there are new complexity of challenges, there are new issues, new problems which have come up, which are not under our control: commodity prices, crude prices, and the impact they are having on us, monetary policy tightening, their spillover, capital outflows, currency depreciation. We are dealing with all these issues, and our target is, and we are confident, and our endeavor shall be to ensure a soft landing for our economy, where inflation is brought down closer to the target of 4% over a period of time. At the same time, the growth sacrifice is not unduly, the growth sacrifice is also within manageable limits.
Thank you, Governor. Soft landing, of course, means that it's how monetary policy plays out over a period of time. So the question I have is, while the short-term trajectory of interest rates is apparent, there still remains some ambiguity as to where we are in the interest rate cycle. Is it an accelerated normalization of rates, which then transits into a rate stability, or is it a response aimed at anchoring inflationary expectations, managing the external environment, domestic?
You see, our approach, as we have said earlier in the last MPC, is, withdrawal of accommodation. The policy rate is still lower than where we were before the pandemic. Before the pandemic, our policy rate was 5.15%. Now the policy rate is 4.9%. In terms of liquidity, we are still below the pre-pandemic level, but the liquidity has been brought down substantially over the past several months, and we had initiated action already through the VRRRs and through the other measures, and so the liquidity has come down, but nonetheless it is still higher than where we were at the time of the onset of the pandemic. Of course, you have a new challenge and a new issues arising out of the war in Europe. So we are still on the mode of withdrawal of accommodation. Our objective is to anchor inflation expectations, and that is how we are proceeding forward. What was the other part of your question?
So whether demand management is also part of it, or again, because it is largely the temporary factors in terms of the external environment, there's a possibility of retracing the steps that we are taking now.
No, our objective, as I can say, as I said, let me just summarize: withdrawal of accommodation, number one. Number two, taking steps and ensure anchoring of inflation expectations. Number three, through monetary policy action to ensure a balance between demand supply. That is something which we are targeting. So it's not a question of compressing the demand unduly or, it's basically finding a balance. The monetary policy, the rates should ensure that there is a balance between demand and supply conditions.
So just a small follow-up on the last part, what you said, Governor. To the extent that predictability is a desirable goal of communication and a policy tool, would a dot plot like the ones provided by the FOMC members be a good idea for the RBI?
You see, first thing is that FOMC meets once in 6 months. Our MPC meets once in 2 months. The situation today, and it's been earlier also, is extremely volatile and extremely uncertain. In such uncertain times, giving a dot plot may create unnecessary expectations on either side. It will create expectations which you may or may not be able to fulfill going forward through your actions. Now you look at it in February first week when we presented the monetary policy, nobody, even around the 19th or 20th of February, nobody expected a war of this magnitude and the impact that it has created. Nobody expected that to happen. So supposing you had given a dot plot kind of thing and you had been very specific that this is how we are going to move, that is representing each member's thinking, then the situation turns totally, completely undergoes a change. So therefore you create unnecessarily, you would create expectations which you may or may not be able to meet. So therefore in such uncertain and volatile times, I think having a dot plot approach is a problem because you have to change your stance every time. And communication, there should be some amount of consistency. I agree, the situation is volatile and as they say, when facts change, I also change my actions. But the point is, broadly there has to be some kind of consistency in our approach. But that whole, that what the dot plot is achieving in US, I feel will create expectations which you may or may not be able to live, and in any case, forward guidance is provided through the monetary policy statement that we are making, and the thinking of each of the individual members is given out when the minutes are released exactly 2 weeks after the MPC. So we are already doing it, but a dot plot and binding yourself to specific points will not work, I feel, in these current times when the situation is so uncertain and volatile.
Thank you, Governor. Let me just now touch on a few areas that you have covered in your speech. Central banks ensure the stability of the financial system by regulating the major entities and activities. How much of a challenge is it to deliver on this mandate when important financial activities, payments, lending, quasi-lending is migrating to unregulated institutions?
That is an issue we are dealing with. There are large number of unregulated, unlicensed entities which are, doing various kinds of lending. There are licensed entities also which are entering into activities which they are not supposed to undertake. So we are dealing with these issues, and as you know, we have formed a committee. The committee's recommendations we have examined, and we will be issuing the relevant guidelines in this regard.